Let me dive into this. So again, at a high level, activities associated with developing and or improving a product and or a process can qualify for the R&D tax credit. And contract manufacturers, I know the NTMA is made up of mainly contract manufacturers. I'm not sure if everybody in here is a contract manufacturer, but it doesn't matter whether you are or whether you're a company that has your own product line. Companies tell us all the time, we don't do R&D, we just get a drawing from our customer and we make the part. And as you all know, that's oversimplifying what you do. So we're talking about a tax credit as opposed to a tax deduction. A lot of people will say, well, they will say, number one, we don't qualify, we don't do R&D, but they'll also then sometimes say, well, we already deduct our costs. What you need to understand here is this is a credit on top of the deductions that you're already claiming. So you're going to deduct all the costs associated with running your business, and then there's going to be a subset of those costs that are also going to generate you an R&D tax credit. And so as John alluded to, some significant changes that Congress made in this past year, thanks mainly to Omar. I give Omar most of the credit for making these changes happen. But significantly more companies are going to qualify for this R&D tax credit. But the bottom line is you are double dipping. You'll deduct the cost, and then there's a tax credit available to you. So what is the credit? The credit's an incentive provided by the government to incent businesses to invest back in the business, hire people, implement automation, technology, do all the things that you need to do in order to compete more effectively on a global basis. So again, high level, develop and or improve a product or process. In the contract manufacturing, are most people here contract manufacturers? I mean, if you're contract, okay, any companies here that have their own product line? Okay, so both, okay. So product R&D tends to be a little more obvious, but again, in the contract manufacturing world, most of your R&D is process related. And process R&D is not just the 1 or 2 times a year when if you go out and buy a new piece of equipment and you spend some time researching equipment, and then you ultimately buy it, you go to IMTS, you buy some equipment, and you got to come back, put it on your floor. That certainly is a process improvement, but you are doing R&D on a daily basis through the processes that you develop to make the parts that you make. Okay, so the easiest way to think about the R&D tax credit, you think about all the jobs you do every year. And it's not just the jobs you actually get, by the way, it's also the jobs that you don't get, but where you're spending time trying to figure stuff out. So you'll do all these projects each year, you'll look at projects you won't get. It doesn't matter whether you get the project or not. If your people are spending time that meet the definition of R&D, which I'm going to run you through here in a second, though all that time qualifies for the R&D tax credit. And any type of business structure can qualify for the credit, meaning S-Corp, LLC, partnership. Doesn't matter how you're structured. If you're doing the activities that meet the definition of R&D, you qualify, but what does matter is the new rule changes. And as John alluded to also, prior to 2016, flow-through entities, S-Corps, LLPs, partnerships often could generate credits but not use them because of the alternative minimum tax. That has gone away, that goes away. The AMT itself doesn't go away, but starting in 2016 you'll be able to take advantage of that. And again, I'll get into that. So the R&D tax credit, this is nothing new, been around for a long time. This is not any kind of accounting loophole or anything like that, even though you listen to the debates and you hear about tax loopholes. This is actually something that both the Democrats and Republicans agree on, but it often gets held hostage to all the negotiations that are going on. But the credit's been around for over 35 years. It is a specialized area of the tax code, so historically, most of the expertise is sat within the Big Four accounting firms. But it's really, I would say, the last 5 to 7 years where that knowledge has really begun to move down, to the regional firms, the mid-sized accounting firms, and the small firms. So when we started the business 14 years ago, nobody other than the Big Four knew about the R&D tax credit. Today, everybody knows about the R&D tax credit because of technology, the internet, information's out there. So it's not new, but it still is very underutilized because it is a subjective and gray part of the tax code and a specialized area of the tax code. Okay, so what every year there's about $9 billion of R&D tax credits that are claimed by businesses in the country. Of that $9 billion, about 60% are going to the Fortune 1000 and larger companies. Yet small business makes up about 90% of the businesses in the country. So the point is that there's a lot of small, mid-sized businesses not taking advantage of the credit, and that should substantially change starting in 2016. Okay, so what I'm going to do now is I'm going to run you through a couple things. First, a definition of R&D, and then the costs that qualify. I've got some case studies. We're going to talk quickly about documentation, and then I will also take questions if there's time. If not, I'll be, of course, hanging around at lunch. But so where does R&D take place within your businesses? You don't have to have a formal organization chart that has an engineering department or R&D department in order to qualify. What matters is if people within the company are doing the activities that meet the definition of R&D. So I'm going to first run you through the costs that generate a company's R&D tax credit. There's 3 buckets of costs that will drive the R&D tax credit. The first bucket, and by far the largest bucket, are the wages of the people that are doing the work. And that can be, R&D can start with a technical salesperson or a technical owner. As John again alluded to, R&D can take place when you're doing estimating, quoting, and you're working with your customers to just define some specifications. And then you've got your CAD programmers, or your designers, or your engineers who are doing R&D. And then you can have quality people that are touching R&D. And sometimes you can have some production people, if you kind of have some go-to problem solvers, they can potentially be doing R&D. But as a rule of thumb, the easiest way to think about it is up until you're ready to go to production, that's R&D. Once you go to production, R&D typically stops. But as everybody knows, you often don't hit the bullseye the first time. You think you're ready to go to production, you go to production, and then something blows up, or the part's not right, the tolerances aren't right, customer won't take it, the part, and now you got to loop back, and you got to figure stuff out. So whenever you're figuring stuff out, that's when you're doing R&D. So you have the people directly doing the activities that can qualify, and then where you also can get a nice bump to your R&D tax credit are if you have owners or people in management that also get involved. A lot of times those people spend some of their time on running the business activities, but as everybody knows, in management or leadership or ownership, you wear a lot of hats. And it's very common for those folks to be interacting with the customers. They like to be back in the shop, getting involved on the manufacturing side. So to the extent you have those people, those types of people spending time on those activities, they often pay themselves fairly well, and that can give a nice boost to your R&D tax credit. So wages are typically by far the biggest driver. Usually they make up 90+% of a company's R&D tax credit. Where there's also, what I like to say, just a little extra frosting on the cake, is that you can also have sometimes supply costs that can qualify. So to the extent you're using up and are consuming supplies to figure, as you try to figure stuff out and figure out how to make a part, those supply costs can qualify. And then the third bucket of costs are contracted research costs. So to the extent you have to go outside of your business for activity or for expertise that you don't have internally, those costs can qualify as well. So if you have to hire an engineering firm, you have to get products tested or certified, those third-party costs can potentially also qualify as well. But again,